guys, sorry to interrupt your video. Just a quick plea, subscribe to my channel please. If you haven't done it already, subscribe. Tell your friends, subscribe. Thanks. Hello. Right, let me explain car insurance to you because it's very confusing, and when you read your theory it comes up with all sorts of stuff, doesn't it really? It's very confusing. Anyway, car insurance explained. Right, insurance is a risk transfer mechanism whereby the risk of me incurring a financial risk is transferred to my insurance company. Alright, that's the whole point of it. So when I drive a car, there is a chance that I might hit something. Alright, the cost of repairing my car and the thing I hit would be my responsibility to pay for. I might also hurt a person or disable them. That person could incur loss of income, reduced quality of life, loss of sight or limbs, higher car costs that they couldn't have had or wouldn't have had if the accident didn't happen, and so forth. Alright, the financial costs associated with a crash could run into millions of pounds. I don't have a spare couple of millions of pounds lying around my house, so I pay the insurance company so that they pick up the bill, right? Just in case. In exchange for agreeing to pay for any loss that I might throw their way, they ask me to pay them a premium, right? Which is fair enough. The higher the chance that I'm going to throw them a bill, or the bigger the bill is likely to be, the higher premium I have to pay. Alright? Simple. Right, risk assessment. Insurance companies use statistics. They analyse loads of data in lots of different categories, and then they come up with things that tell them what is historically likely to be a good risk or a bad risk or whatever. Okay, there are more factors than I'm showing on the screen right now, but let's go through it. Let's give it an example. Okay, the most common ones. So for instance, 17-year-olds crash a lot. They have therefore high premiums, whereas 45-year-olds crash less and therefore they get lower premiums. Expensive cars equal high bills to repair and therefore they have high premiums. Cheap cars equals cheap bills, therefore lower premiums. Points on your license? Naughty. You are a high risk driver and therefore you pay high premiums. Postcode has a lot of thefts in it. For instance, London, for instance, they get higher premiums because the postcode is registered as having a lot of claims on it. Right? Do you park on the street? Therefore, it's easy pickings for theft. Do you park in a locked garage? Therefore, it's out of sight, out of mind. Therefore, you get a lower premium, and so on and so forth. Okay, I mean, these are just examples. You get insurance groups. Okay, so cars are grouped by insurance group via Thatcham, and the lower the group, the lower the premium, and it's basically based on the cost of repairs, how easy to run it and repair it in the event of a crash. So for instance, there are 50 groups, and I've got a sneaky feeling that the 50th group is broken into 7 subgroups actually. However, I haven't found that anywhere. That might be just me making that up. So for example, groups 0 to 5 you would be like your Fiat Panda, Citroen C1, Ford Ka, etc. Okay, they are slow, they are cheap to repair, cheap to run, all the rest of it. Therefore, if you were to damage them and the insurance company has to pay out, then the amount they pay would be quite low, and therefore you get cheaper insurance. As we saw, you can have a look at the screen yourself. The groups go up depending upon how much it costs to repair and how likely it is that you're going to crash the car. So for instance, group 6 to 11 a Ford Fiesta appears, but that could be just a 1 litre 80 horsepower version, but they do a Fiesta ST, which is almost a 200 horsepower car. That would not be insurance group 10. You're talking 15, 16, something like that, because that is being classed as a sports car now. So therefore, the type of person that drives it is a bit more aggressive, a bit more, they like the fun out of their car, so therefore they're going to push the car, therefore they're more likely to have an accident, or when that accident happens it's going to be a big one because they're going to be travelling at speed, and so on and so forth. So you tend to find that a type of person buys a type of car, and therefore the car is lumped into that sort of bracket as well. You know, it's all relative. All the way up till you get your Group 46 to 50s. This is where you're getting your Porsche, your Lamborghinis, your Aston Martins, Ferraris, Range Rovers, you name it. Anything that's going to cost a fortune to repair, or is very quick and therefore could hit something at high speed, is going to be in a high insurance group. So if you want low insurance premiums, get something which is in groups 0 to 5. Alright? It says 0 to 5. I took that from a website, but I think you have to start a group 1, surely. You can't start at 0. Anyway, I've never found a group 0. Right. First party, third party. What the flip? What's all that about? Okay, now this is all terminology. Right. Now, we've referred to people involved in insurance as the first party, second party and third party. The first party is the person who buys insurance, so that would be me, right? The second party is the actual insurance company that I buy insurance from, and the third party is anyone else who's out there who we might come into into correspondence or connection with as a result of a claim occurring, right? So the person who I hit, or more likely they're going to hit me, all right? But from their point of view, they are the first party, their insurance company is the second party, and I am the third party. So whenever you're phoning up an insurance company and you're asking for the other person's insurance, you always say, I'm looking for the third party's insurer, or I am the third party, that sort of thing, when you're talking to their insurance company. Things like that. So it's all relative again. Right, that's your terminology. Next, what is a no claims bonus or discount? Right. A no claims bonus, NCB, or discount, NCD, is a reward for not claiming on your insurance. So every year you have insurance and you haven't claimed on it, you earn another year's discount off your next premium. So you get, after the first year, you have 1 year's no claims discount. It does vary between insurance companies. Some allow up to a maximum of 5 years, some 9. I've seen 20. It does vary a lot. Okay. Yeah, it depends on which insurance company you're with. And each insurance company you're with will give you a different amount of discount depending upon the amount of years that you've got. Okay. The discount is tied to a specific vehicle, but if you change your vehicle, then you can normally swap it to the new vehicle. Alright, so I have 3 cars. Three cars. So I have 3 different no claims discounts. And if I were to buy a car, I would just move a discount from the one that I sell onto my new car. Yeah, that's the way it works. If you were to buy a second car, for instance, they will sometimes mirror your no claims discount that you have on your current car over, because you've proven that you can drive for 10 years without crashing your car, so you've got a 10 years no claims discount on that car. So they will say, well, clearly you're good enough, so we will mirror it over, and after 1 year then you now have, it's not a mirrored no claims discount anymore, it becomes its own individual discount. So if you crash the first car, then it wouldn't affect the second one. That's the idea. If you change your insurer or you sell your car, you will get a letter of proof of no claims discount from your old insurer. Okay, you get them to email it over to you, and you have to hand that letter onto your new insurer as proof of no claims discount. Now, typically it's only valid for 2 or 3 years, so if you don't buy another car within that period, you may have to start again. All right, and if you make a claim on your insurance, you typically lose 2 years of no claims discount. Obviously, if you've only got 2 or 1, then you're going to go straight back to 0. Yeah, that's the idea. Okay, so I had to dig around. I found Admiral Insurance as an example, and this was what they were saying for the average discount in 2020. You can see on the screen, so you've got years of no claims bonus. One will give you a 5% discount in the second year, so because you've now got 1 year, so the second year's insurance will have a 5% discount. After 2 years you get 12, and so on and so forth. You can see what the screen's saying. Up to 9 or more for 36%. I have seen other insurers who will offer up to a 75% discount when you're starting to get up to the 20 years, that sort of level. So based upon that, Admiral doesn't look like a particularly good deal to me, but they could well be doing something else. Depends upon what insurance. I mean, you know, it's all discounted at different rates. They all have to compete against each other, don't they? Whether or not somebody says, oh yes, I give you 20 years discount, it might be the same amount of discount that you get after 9 with somebody else, you know. So you'll just have to phone around, ask a broker, they'll sort it out for you. Insurance levels of cover. Okay, so there are different levels of cover that you can buy. You've got third party only, third party fire and theft, fully comprehensive, and once you have fully comprehensive, if you pay an additional premium, you can get your no claims bonus protected, so that you don't lose it if you make a claim. Right, here we go. So third party only. Right, so this is the legal minimum level of cover all drivers must have before driving on the public roads. Okay, so this is absolute minimum, and this covers any loss to somebody out there, the third party, that you may have caused them. So if you hit another car, at least your insurance company can step in and pay the third party back for the damage that you've caused. You still have a knackered car, but at least the other person won't sue you now because their car has been repaired. Next level, third party fire and theft. So it's the same as third party, but also if somebody were to steal your car and burn it out, for instance, then you can claim back for the financial value of your car when it was stolen and burnt out. Fully comprehensive. This is the same as third party fire and theft, and any damage to your own car that you may cause, so you might drive into a bollard or something, or a metal post, you can claim off your insurance company to get the cost of the repairs back, or a new car, if it's a new one, of course. Then, if you want to, you can have fully comprehensive with a protected no claims bonus. So pay an additional premium, and what it means is your no claims bonus is unaffected if you make no more than 2 claims in a 3-year period. But in the year that you make a claim, then you won't accrue an extra year's no claims bonus, if you see what I mean. I hope that makes sense.